Well, first up, sorry. The fundamental challenge facing investors in any market cycle is dealing with uncertainty. And the market has painfully taught investors that whenever something looks like a sure thing, it probably isn't. Trying to deal with uncertainty, ReCM believes building a collection of diversified, undervalued assets.
Pete, and these we wanted to get you in here. You've given a great example of how to build these diversified assets and essentially handle this uncertainty from that the market throws at us. You've been through a couple of cycles. Just give us some insight there as to what constitutes a portfolio that can handle any uncertainty.
Yeah, if I can maybe just take a step back. The important thing to realize is there's two ways of dealing with uncertainty. The one way is to make some sort of forecast about what you expect to happen in the future and then aligning your portfolio with that forecast. We think that's not a robust method of dealing with uncertainty, because if your forecast is right, of course, you deal with it very well and you look like a hero. But if your forecast is wrong, or the assets you've employed to deal with your forecast are the wrong assets, you could end up losing a lot of money. And we think that the biggest sin in investing is losing money. The winner investing is not the one who wins the most, it's the one who loses the least. So we try and put together a portfolio that can deal with uncertainty in a better way, in a more robust way. And what we do is we put together a portfolio of diverse assets with a common denominator that they are all cheap or undervalued. So we hold stocks in different industries, but these stocks are all cheap. We stay away from expensive stocks, and we just put together a portfolio of diverse interests in different industries, all of them undervalued, because, and this is very important, because of the uncertainty out there, it can impact any one of your holdings in a way which you can't sort of foresee or build into your valuation models. And even with the best intentions and the best research and the best analysis, you're going to get it wrong sometimes. And one of the ways to protect yourself against things going wrong in an arbitrary fashion is to build in a margin of safety into the assets you own, into the prices you pay for the assets you own.
Now, Pete, looking at certainties, you also talk about certainties that were not certainties. So the herd, the conventional wisdom saying, oh, well, this time we've hit on something that we know is going to be good. And you give the example of the late 90s and the high tech, the investment in those tech companies.
Yeah, the bottom line is the human being loves stories. We all respond very positively to stories. And once there's a dominant story out there, it drives us into the same sort of assets and drives the result is it drives the price of those assets upwards to levels which makes them very risky, despite the story being true. So let's take a couple of examples. If you go right back to the mid-90s, there was a whole Asian tiger. The story was you had to invest in Southeast Asia because of the increased productivity and the massive growth coming out of those Southeast Asian tiger economies. Of course, that all fell in a heap in 1994. And then you had emerging markets in general and small caps in South Africa, more specifically in 97 and 98, when we had that small cap boom and every fund manager was launching a small cap fund. And that all ended in the emerging markets crisis of 1998. And then we had the IT bubble in 2000, which ended in tears. We had the Rand bubble in 2001, 2002, when everybody had to be offshore. You had to be in London or New York with your head office. You couldn't operate in South Africa. South Africa was ex-growth. That was the story. And that was, people were queuing up outside the banks to take money offshore at 15 Rand to the dollar 10 years ago. Then we had the US property story, and then we had the commodity super cycle. There's always a story. And we tend to buy into these stories and chase the price of those assets that are associated with the stories up to unsustainable levels. So that it seems to be a low risk situation because of the strong power of the story. For that story it's grounded in the truth, but it's just taken too far. And that's the problem. So at the moment, there's a story out there which says interest rates are so low, I can't get enough income on my interest-bearing assets. Therefore, I need to take more risk. I need to buy equities high-yielding equities. And it just so happens that those are the equities of good businesses like Rembrandt and SA Breweries and Richemont, fantastic businesses with nice dividend yields, and that is what investors are buying because competing interest rates are so low. And the story there is income, dividend growth, good quality businesses paying nice dividends. That's the story today. And we think there's a huge amount of risk in that story.
Obviously, Pete, that comes back to the price valuation, and just take us through the sense you get. Obviously, this fascination with forecasting is quite amazing because despite people knowing the difficulties with forecasting, we still continue to do it. We've got a whole sell-side industry that forecasts earnings from 1 to 3 years out. So in the absence of forecasting, what then do you use to apply your minds to get to a decision around what a cheap price is for a business? Because at some stage you've got to make a call on what you expect that asset to give you in the way of cash flows going forward.
Warren, that's a key question. So what we try and do is we try and normalize the earnings power of these businesses. and so what we spend our time on is not forecasting where the economy is going and interest rates and GDP and all these numbers economists talk about. We spend our time studying the economics of businesses and industries. So we try and get a sense of how profitable a business can be within a certain industry. Different industries have different characteristics. Mining companies, good mining companies, have very high margins through the cycle, but they require lots of capital. Finance companies have very low margin, but high returns on capital because they leverage those returns up. So we spend a lot of time trying to understand the economics, how the cash flows from the client of the business, through the till of that business, through to the shareholders of the business. So we try and understand that on a normalized basis without making any forecast where the economy is going this year or next year. Because what we do know, we don't know very much about the future, but what we do know is that if things are looking bleak now, at some point they will turn up. And if things are looking fantastic now, at some point they're going to turn down. And because owning the equity of a business is a long-term commitment, you will own that equity through up and a down cycle. So we try and average those things out and normalize the earnings and try and understand what normal earnings is for a business. And we base our valuation on that sort of number without making any forecasts at all.
We've got, you've carried that philosophy and approach, Pete, into some of the portfolios that you guys run. And obviously we wanted to talk a little bit about the ReCM Flexible Equity Fund, which is a domestic equity fund, and very unfashionable companies appearing in that. I have to ask you, I understand the approach, but surely, and I'll just refer to some of the stocks in the portfolio. We've got Anglo American, Amplats, Lonmin, ArcelorMittal, Implats, I think all very unfashionable at this point in time.
And if I could come in there, Warren, Telkom, perhaps the most unfashionable of the lot. I mean, there are not too many portfolios that would have Telkom at the moment. And a JD Group with the exposure to the furniture. So as you say, Pete, you have to justify those.
So, if one says, if you're a value investor, you are looking for situations where assets are undervalued. Now, they predominantly get undervalued in situations where nobody is interested, when there's massive aversion. When the crowd is all running behind the story of the day, lots of debris gets left behind. When nobody's interested, where things have gone bad, where there's been earnings disasters and that sort of thing, and that is where we hunt. And that's where we look for situations where undervalued assets might be. Now, you mentioned some of these assets, Impala, Anglos, Amplats. It's not that long ago that these companies were regarded as model citizens of the JSE. When Amplats was trading at 1,400 Rand a share, compared to today's price of less than 300 Rand a share, people loved the stock. They thought it could do no wrong. When Anglo American was trading at over 600 Rand a share compared to today's 200 Rand a share, people thought Anglos could do no wrong. Every iron ore mine it bought, every expansion it did was applauded by the market. Well, those chickens have come home to roost, and the price is now a third of what it was 5 years ago when it was the blue-eyed girl of the market. And and we think it's still the same business. It's not as good as people thought it was in 2007, 2008, but it's definitely not as bad as I think it is now. The truth, as always, is somewhere in the middle. And that's the case for all of these companies that you've mentioned there. There's massive aversion, there's massive distaste. They don't fit in with the story of the day. They get left behind. They're cheap.
Peter, just wanted to ask you.
By the way, good things tend to happen to cheap assets.
We've got some very big companies in the top 10 there of the portfolio. I just wanted to get your opinion on ReCM. I know you like to buy quality businesses that are heavily discounted and have lots of bad news around them. What's your sort of approach been with the small and mid-cap shares on the JSE or in other markets? Are you interested in buying businesses that are a little bit smaller, but perhaps have characteristics that are not dominant in their markets or in the industries in which they operate? What's your sort of approach when looking at those types of companies?
Yeah, so we listed an investment company about two and a half years ago called ReCM and Caliber, in which we specifically buy smaller businesses, the equity of smaller businesses, whether they're listed or unlisted, doesn't really matter to us. But they need to fulfill three criteria. They need to be good businesses run by good people, trading at a good price. And we've accumulated a grouping of holdings in such businesses, and we're still out there looking to buy more of those type of businesses. The only thing I can say about that, where we stand today, is small caps in South Africa are a lot less cheap than they were 3 years ago when we started out. So right now there's not that many buying opportunities, although with the sentiment change we've had in the market over the past week or two, maybe they'll come up again. But at this point in time, the value is predominantly in the large cap cyclical portion of the market, the non-dividend paying portion of the market, the portion of the market that's not part of the story of the day.
Peter, it reminds me a little bit about Warren Buffett. You know, they ask him how he makes his money. He's the best investor in the world, they say, and he tells them, but they don't listen. Do you find that people say, tell us, and then they don't listen?
Yeah, look, I mean, the stock market is such an emotional place that to do what we are doing, one actually needs to switch off sometimes. As I said, I've been through this many times before. It happens every 4 or 5 years that the market takes a story and just runs with it. And value investors such as ourselves, you look pretty foolish for a while, and people aren't really, they don't want to hear what you have to say. When you put up your top 10 and it's Anglos and Amplats and Impala, they switch off. They want to talk about Naspers and SA breweries and exciting stuff like that. We think good returns come from the unexciting part of the market, and that's just our DNA, and that's, we've done in the past and we'll continue doing it through the cycle into the future, and it's left us with pretty good returns over time, so we're quite happy doing that.